I'd like to welcome everybody to our panel this morning, Closing the Deal. How are you getting deals across the finish line? So I know it's a time that a lot of people feel that deals are not getting done, but we're going to talk about deals getting done. I am Rob Gilman. I am a partner and leader of Anchin's real estate practice. We are a CPA firm specializing in all aspects of accounting and tax planning. Let's just go around and have some brief introductions. Awesome.
Hi, good morning, everyone. My name is Ossie Simbel. I'm the chairman of Simbel DLT Companies. We're a South Florida-based real estate developer, vertically integrated developer and real estate investor. We also have a construction company that builds all of our institutionally sized projects, and that builds also for select clients in South Florida. We completed in the last 18 months about 650 units. We got a $2 billion pipeline, including a significant district in downtown Fort Lauderdale. And we're about great design, architecture, original art, wellness, technology, and sustainability.
Good morning, everyone. My name is Gabriel Troncoso. I am the principal and founder of Dimes Capital Group. We invest in multifamily acquisitions with a focus on workforce housing and preservation in Central to North Florida. We launched in 22, and we have about 1,500 units in the pipeline.
Hello, everyone. Francisco, pardon me, my voice. I'm losing my voice from all the conversations today. Francisco Herrera with Peak 15 Capital. We focus on two verticals, work closely with institutional equity partners and allocators, and as well as operators, really marrying capital and deals across various commercial real estate assets. And we also focus on existing value-add multifamily deals in the Sunbelt Southeast markets where we capitalize through a co-GP structure through our GP fund.
Good morning, everybody. My name is Saul Levy. I'm a partner at PIA Residential, which stands for Property Investment Advisors. We own stabilized multifamily assets through the Southeast, approximately 1,400 units at this point. Right now, we're working on a deal in Atlanta, 232 units, which is due to close in the end of April.
Hi all. Sorry. Lavi Rosenthal. I work at Prospect Capital. Prospect is an $11.3 billion asset manager. We have different verticals in corporate credit, private equity, CLOs, and last but not least, our favorite, real estate. Within our real estate book, I'd say predominantly we focus on multifamily value add, but we also take a look at senior housing, assisted living, and student housing.
Great, thank you. So let's start with a question right on topic. Have you gotten any recent deals done?
Yes. Well, we just completed our 6-acre assemblage in downtown Fort Lauderdale. We owned most of it for a while, but we just bought a warehouse to complete that district. That'll include several high-rise rental towers, a branded condo, branded hotel, branded yacht valet, and we're working on a bunch of other deals. But I think the topic of this discussion, deals are more challenging to get done, and we're a lot more selective on the kind of deals that we will get done now.
Yeah, we're fighting through the process right now, but within the next 15 days, it should be interesting.
Yeah, I mean, for us, I think the timing was good. When we launched our fund early of 2023, we were able to roll our deal into the fund, first deal in Atlanta, but 2023 has just been extremely tough. It was a big pause, not a lot of capital out in the market, a lot of capital on the market, just not a lot of it getting deployed. So since then, I mean, it's just been, we've been looking at a lot of deals, but just being a lot more selective, just given where really the capital markets and the landscape sits right now. Looking at a lot of loan assumptions, and so right now we're under contract in the deal, currently 281 units in Birmingham, Alabama. That one's a loan assumption, so still looking to kind of continue to push forward, find some deals. I think now we're starting to see an uptick in some of these deals and transactional volume, but I think we're going to start to see more opportunities kind of come in the latter part of this year for sure.
Yeah, so I mentioned we have a deal in Atlanta under contract. We do a lot of looking and searching of deals. Last year, we looked at 500 deals and just bought one. But we understand that you can't fight the market. You have to understand what the market is telling you and be conservative in your underwriting. We bought during COVID, we bought at the rise of the interest rates, sticking to a disciplined underwriting and being very thorough in looking at every possibility there is. This one is an assumption that made it work for us. And that's what, it's just in our DNA to be disciplined and look at a lot of deals before we pull the trigger.
Yeah, to kind of echo what a lot of people are saying on other panels, and I'm sure what everyone here is experiencing. I think the bid-ask spread is slightly wide right now, and it's interesting because at many times throughout the year and throughout different markets, we kind of sit on both sides of the table, right? So as a buyer, I'm making the case as to why my bid is the correct bid, and when I'm sitting on the other side of the table as a seller, it's like, well, I'm kind of going off whatever the broker tells me because they're incentivized to kind of raise that price as high as possible, right? So I think there's a divergence of incentives there. But I think all of us are in the rock turning business, right? We kind of need to turn every rock to, until you find something that kind of works. Whereas 3 to 5 years ago, maybe, 1 out of every 10 rocks, kind of made sense. And today it's probably like 1 out of every 50, right? So that's kind of the way that we're seeing the world these days.
Okay. So when you're looking at deals now on new acquisitions, what's the bigger issue? The current interest rates or valuations, or what the seller wants to sell the building for, or thinks that they should be getting?
Well, we do ground-up development, so we just need to back into a yield that makes sense, that takes into consideration the current interest rate climate and the exit on the refi. And deals are, more challenging to get done. Financing, it's not so much the interest rates, which is a challenge, or the construction costs, which also is a challenge. It's, it's leverage points that lenders are willing to give. 18 months ago, or actually, I think it was 12, maybe 15 months ago, we closed at a 90% leverage on a construction loan, over $100 million loan. And those same lenders are lending with the same spreads at 65%. So more equity is required for the deals. It's tougher to get a return of equity. We like to give our guys at least a 30, 40% annual return on equity. So it's a lot more challenging to do it in this climate.
I think there are a lot of challenges coming from the unknown, like where we are in the cycle right now. So you have to be conservative on the underwriting and trying to there's a lot of headwinds. So you don't know where rates are going to go, and then the LP and the GP shops are trying to really scrutinize your exit caps. There's a lot of talk about all this debt coming due and what that's going to do to the market, so no one really wants to catch a falling knife. So your spreads in there, you have to bake in a pretty solid juice up front. And if you look at the way that operating costs are going up, it's putting downward pressure on prices and then convincing the seller that this is the reality. What I'm seeing is that a lot of times the market's just speaking for itself and just letting the sellers know this is where true value is. And if you can bridge that gap and work with the broker to do some realistic underwriting, be very transparent of what you're looking at, because no one wants to see rent growth in year 1 or 2, then you can get to the finish line on a deal.
I feel because we're kind of on both sides. We don't do ground up, so I know it's been a lot more difficult as far as on the ground up side. We see ground up whether we're just placing from institutional capital or we're looking at it from a co-GP just on stabilized assets. But I think it's a little bit of both. I mean, as you see, valuations and interest rates somewhat are still correlated. You're just getting a lot more pressure from the lenders at this point, given the fact that a lot of the transactions that have happened in the past 2 years, it's been kind of a bit of an anomaly, to say the least. So you're getting that pressure from lenders now where in 2023, they were at the table getting negotiations, extensions, and so forth, but now it's, can they already continue to still stomach what we're going through right now? And so that pressure is just either valuations continue to decrease, more and more lenders are going to be exposed to that risk of them kind of blowing out some of the regulatory covenants, and they'll have to kind of continue to reduce to get their leverage kind of on the healthier side. So you're kind of dealing with both, really, and I think just for us, we need to continue to, we're still being conservative in our underwriting. We want to continue to see healthy spreads, reason why we're kind of shifting more on the loan assumption side. But then again, you also have to look at it very closely and make sure you're not paying a premium on that loan assumption, because you can have a loan assumption that's it's accretive, but if you're still paying a 4 or a 4.5, 5 going in yield, you don't have sufficient spread there as you were, especially on a value add. We like to see more of a deeper buffer, especially if we want to kind of get to those return profiles for our investors and the appetite that's out in the market.
Yeah, it's in interest rates and sellers' psyche and as to what they see the future and their options going forward. And insurance has also played a big role in that dislocation between what buyers and sellers want. For us, like I said, stick to a disciplined underwriting, and we really try not to force the market. However, we have enough of a good reputation among the brokerage community that when we are participating in a bidding process, they know that we're going to close. They know that what we're offering, we do a lot of work at the forefront before we go into a bidding process, so that they understand that we are looking at the investment seriously. We bring a lot of our teams in visiting the property, visiting the market, getting a lot of information and feedback before we make an offer. So we're very selective in that and very thorough, and I think that helps sellers understand that they're dealing with a serious company.
Yeah, so a lot of times on our front, it's instead of focusing on what we do know, we really try to think about what we don't know, right? And what we don't know is where cap rates are going to be in 5 years, and also we have no idea where interest rates will be in 5 years, right? So we kind of eliminate that sort of variable from our underwriting, right? We try to we really try to eliminate most variables that we could, right? So we take away any capital markets execution that we think might alter a business plan, right? So we try to think of, okay, a few thousand some odd units that we're currently renovating in the market, right? What are we getting in terms of rent pops? How fast is that happening? What's the average cost of those renovations? Like, I'd say that we are very data dependent on what's currently happening. So just taking a quick look, right? If you look at the public markets, right? A lot of us all transact in private real estate. If you look at the public markets and where some of the REITs are trading on operational kind of performance, the REITs are like at high 6 or 7 caps, right? I don't know if everyone here has, a high 6 or 7 cap readily available that a broker is sending them or that they're originating from another, sale. It's just not there, right? So there's also a bid-ask spread, and there's kind of a discrepancy between what we're seeing in the private markets and the public markets. And that's just a matter of fact that the public markets might overreact, but we're kind of listening to that and saying, well, what happens if things do move a little bit higher, right? If rates stay higher for longer? I mean, I kind of hate saying that, right? But like, that could be real. Or, a lot of times you think about, fine, this is a great deal as a loan assumption, and we're loving those deals today. But in year 5, when we're looking to sell, the next buyer might not have the optionality to have this as a loan assumption. So what is the appropriate cap rate that we're exiting at, right? And we really try to be conservative in those assumptions, and in all honesty, a lot of times that, makes deals not work.
Okay. Francisco, just to follow up on the loan assumptions, because the banking, and we're going to talk about capital markets, but the banking, there's a lot of turmoil going on in the banking markets. Are the banks willing, to take on? I know there's a cost, but how difficult is it to get a loan assumption done?
You know what? I'll say from our experience for our first deal that we rolled in, that was also a loan assumption in Atlanta. Things are a lot different now, especially with agency. So with Fannie, we had a great relationship with them and had a very, I guess you want to say, a good process as when we did the Atlanta deal. Not so much right now on the deal in Birmingham. And I think it's definitely now starting to kind of impact as far as how capital is being structured on these loan assumptions. Again, we're still in a landscape where capital is still not moving as how we want it to move. And so, of course, pref has been kind of the flavor of the year and continues to roll into 2024. Well, that is starting to kind of be somewhat of a problem. The current deal that we're in right now is a Freddie, and even Fannie changing. From what we heard back in December, they're starting to kind of change their guidelines, and they're kind of working through that. So it's definitely looking at pref being a little bit more challenging in how it's getting structured, even from a loan assumption. Again, just given the fact that equity is being a little bit more difficult out there, and it just seems like every JV LP allocator who is out now kind of shifted gears and shifted more towards the pref. And so it's really, how is that pref or that operator, how they're structuring it, how are they getting agencies comfortable if in the case, because again, agencies looking at it with more scrutiny, and so they want to be able to feel comfortable as who is this pref group, if in the case some of those provisions or triggers do come into place, are they going to feel comfortable for them to kind of operate on the deal, or what's going to be the case? And so it's made it a little bit more difficult for sure on lending, even from an assumption side, that we're starting to kind of see it now.
Okay.
I just want to quickly add that we do pref behind both agencies, so.
So
Let's chat.
Let's stick to the capital markets, just to hear how everyone else is navigating the capital markets.
What's the question?
Yeah, how are you navigating the capital markets and getting your capital?
Well, it's definitely bumpy. I mean, listen, we closed on $250 million in the last 18 months. We're going to close on $350 million in the next 4 or 5 months. We're in a lot of, asset classes: land recap, ground-up development, pref equity, refi, bridge, So, it's, there's money out there. The spreads are higher. Obviously, SOFR is high. And it's more challenging to get the deals done, definitely. So for our ground-up project, multifamily is more challenging. Last year it was easy. Now we got to work for it. But I think for top-tier sponsors, you get the deals done, and hopefully at a number that makes sense.
So we exclusively target affordable and workforce housing, and there's an abundance of money chasing that. So they're saying, but the scrutiny on the deal is a lot tighter. So we'll pursue on the debt Fannie and Freddie. They'll look at deals that check their impact box. We will self-restrict units to get better debt terms from Fannie and Freddie, and that can make deals and preservation plays work well. A lot of capital was raised through these rent preservation impact funds, getting the groups comfortable with that particular asset. I mean, right now, there's a lot of pressure on 70s and 80s vintage assets because the LPs have walked away from them. So, but that's an ideal product type for you to hit that missing middle band of 80 to 100% AMI rents, and it needs to be preserved in the supply. So it's just about talking through everyone is scared of what they don't know, and you're dealing with 50-year-old assets and what's there and how the capital stack will be put in. So sometimes you have to get a little creative, and we're doing like public-private partnerships since we're self-restricting, talking to cities and counties and states and seeing how they can offset some of that CapEx need in there with some deferred loans or 1% loans on those deals. So you just have to get creative to put everything together. So the money's out there, and last year not a lot of capital was deployed, so I know the money's burning a hole in their pockets, but no one wants to be caught making a mistake.
I don't know if there's anything else you want to add.
Oh, no.
So, yeah,
that was-
Yeah, so on the debt side, we use agency, fixed debt, 10-year money. All of our portfolio is financed with that. We feel we're fortunate or happy at this moment that there's some other groups requiring to make capital calls because they use floating debt. At the rise of the interest rates, that was very frustrating for us because we couldn't pick up as many deals as we wanted, but now it feels good. So it's part of our conservative nature. So we'll stick to that. On the equity side, we have a $100 million fund. We raise equity in Latin America. We do sidecards with that fund also, co-investments. But basically, it's trying to define yourself as what do you offer that investor? What is it that how do you think about investing? You know, we're about capital preservation more than anything. So some investors want the heavy value add and high return, high IRR. We don't play in that space, and that's fine. It's not for us. So we try to do medium to light value add projects where if the market changes, it's not going to find us with 40% of the property empty. So we keep pushing that, and that has served us well, and continue to grow our portfolio, which is around 300 million AUM now, 1,400 units through the Southeast, and intending to be 5,000 units over the next few years. But we're in no rush to grow that recklessly either. So, yeah.
Yeah, I think the original topic was about capital markets, and I guess the first thing that kind of popped to my to mind, you know, when I was younger, this might sound funny, right? When I was younger, I didn't love all the food that my mom used to give me, right? And what would I do? I would add ketchup, right? And you might ask yourself, like, well, what does that mean, right? And like, if I put enough ketchup, I'd really just be tasting the ketchup and I wouldn't care for the food anymore. I think the same thing applies to the leverage that we're looking at with assets, right? You know, you might look at a deal, and based on the sort of debt that you can, you know, tag onto the deal, now you know, you kind of flip that into your model and say, well, this looks and feels really good now. But does the deal make sense if the debt wasn't there, or if the debt was different? Would that deal still make sense, right? So I think that's a question that we all need to be asking ourselves, and that's something that we ask ourselves every day when we look at things.
Okay. So the commercial markets, which, good thing we're talking about multifamily, the Class A properties are doing much better, and the Class B, you know, who knows if they're even going to survive, and there's talk of converting them, which is a whole separate issue. In the multifamily space, is there a difference between the Class A and the different classes of properties that you're looking for?
Well, we only do Class A projects. So, you know, we have a lot of, you know, data on Class A. I mean, it's definitely in favor here in South Florida. You have real rent growth, or at least you had until very recently. You had real people coming down with high-paying jobs, paying, for that asset class. And I think really that's that's the future in South Florida, but at the same time, it's also pricing people out of our markets. So, there are different ways of kind of dealing with that, like with Live Local, that was enacted in Florida that we're taking advantage of. So, we can just, we can only speak to Class A assets.
I'd say, I think there's a flight to quality. So since value's coming down, you can get solid yields on newer vintage assets. And then here in Florida, the insurance dictates a lot of deals dying based off insurance. So if AmRisc is not looking at properties older than 85, a couple weeks ago, they just said they'll do 1980 vintage assets if they're more than 5 miles from the coastline. So that plays a big role depending, where your insurance rate is, what will pencil. So if you know that you can get enough competition in the insurance and bring down your premium cost, and you can jump into a newer asset with less maintenance issues, I think a lot of capital is just going to chase that.
Yeah, that's a good point. I mean, we dealt with insurance issues that looked favorably on Class A assets only, and there are insurers coming into the market who just want that. So that's an excellent point, actually.
I'm sorry, can you rephrase your question?
Just if the type of assets, the class, in multifamily, Class A versus Class B versus, what's the best asset that you're looking for and striving?
I think something to really look closely is especially even for us, we're not in the business to change neighborhoods, right? So it's kind of, in some ways, it's kind of difficult to kind of range to see what class a certain property is. I mean, you really just have to look at that area. But if you're looking at it from a vintage standpoint, we've definitely shifted our gears for us to kind of look at more kind of post-90s, 2000s, just because, again, going to your point, Gabriel, is that we've definitely seen more favorable yields, even on the newer class. We're not afraid of it. We've done it. I mean, just on our Atlanta deal, that was a 70s product, heavier value add. But we felt confident in ourselves and in our operator, our co-GP, for them to be able to execute on that plan. Will we do it again? Probably not. So that's why we're kind of just shifting into kind of more of the B plus kind of assets in good areas, good neighborhoods, good demographics, good economic fundamentals that are in place that would have a lower execution risk as opposed to kind of like a full repositioning of a property and a tenancy. So especially with costs continue to inflate, we want to kind of mitigate that and see more favorable yields and returns, especially on the newer class. But for sure, we've even seen it, again, good point, that even on the insurance side, insurance is playing a big part as well, and they're starting to kind of shy away even from the older vintages again as well. So you kind of have to battle between those, and so it almost, in a way, pushes and forces you to kind of look at the newer assets, even though you're used to, and I'm sure a lot of investors are also used to more higher yields that you will achieve on the older assets, just because they're kind of in a sense being overlooked, or equity is really not chasing them as well.
Yeah, so we played in the C space for 10 years, from 2008 to 2018. We were in the SFR space. We assembled a large number of single-family homes here in South Florida. Those were 1965 built, and they came with a lot of deferred maintenance. So as we transitioned into the institutional multifamily space about in 2019, we figured that we didn't want to be in the C space. It's tenant credit burden space with a lot of deferred maintenance, as I mentioned. We mostly wanted to play in the B space, be defensive in that sense, because those are properties that should pencil with rents of $1,100. So pretty much everybody can afford those rents. We didn't go to the A space because those required higher rents, and all our box is very defensive. However, what we're seeing is that there's a lot of developers that are struggling now. They have stress in the sense that they were hit by the COVID, delays in their construction, higher cost of raw materials that on the other side of that of the pandemic, and then higher interest rates and lower rents. And we're seeing sort of lowering of pricing on the A space that it's worth looking at. And we're starting to look at opportunities at, core plus and lease-up opportunities, and maybe cater to a different set of equity partners in that space. But I think that it's always a very attractive space if you play it right and with the right equity alongside.
Yeah, so I'm, kind of loving taking in that everyone's focused a little bit more on the newer vintage and the Class A product, because we really want to be, fishing where there's a lot of fish, but not a lot of fishermen, right? So we're happy, looking at that lower class A affordable rent by necessity, product. And a lot of times we find that in the late 60s, the 70s, the early 80s vintages. And I'd say over the last decade, we've had no issue with getting our hands dirty with, executing business plans with sponsors that are a little bit more opportunistic. So, when you're kind of the only bidder in a competition or in a market, you can kind of, push to dictate pricing, which is always what we try to do. So we actually kind of like the, C plus, B minus space.
Now, I know some of you are geographically located, you look in a specific area, but where do you feel are the current hot multifamily markets in the country?
Well, I think we live in a bubble here in South Florida, right? So everyone's, moving here. Lenders prefer to lend here. So our focus is in South Florida, in Broward, Palm Beach, Miami-Dade County. We like those areas, and we're going to stick to those areas.
I'm biased. I like Central to North Florida.
Okay.
It's a booming market.
Yeah, we're going to continue to look in where we know, which is in the Carolinas. It's our backyard. So very familiar with the Carolinas. I think there's still a lot of opportunities there, even though many may think that some of those markets are very overly saturated. But we have our eyes on a few markets that possibly could be slightly overlooked, especially not as a heavy footprint for institutions, but definitely it's something that's on our radar.
Yeah, we buy through the Southeast, Birmingham, Central Florida, North Florida, Georgia, the Carolinas, North Tennessee, and Tennessee. Did I say Georgia? Georgia, okay. In Georgia, we like Savannah a lot. There's obviously some, Atlanta is main for us. We have a regional there. Central Florida, Tampa, Orlando are really interesting. We do primary, secondary cities of the Southeast, and we don't do South Florida these days because we can't find the yields here, although it's a fantastic market.
I think a lot of good points. Our 33,000 some odd units that we either operate wholly owned or through joint ventures, really spread out across the East Coast. I'd say that we're agnostic to location specifically. I know a lot of capital allocators want to be on Main, but again, we're happy looking at secondary cities and even tertiary, right? Which no one will say publicly, but I'm happy to kind of sit here and say that. Two things that we kind of take serious consideration into when thinking about a new locale. A is pen risk, right? Can someone in the local municipality just get voted in and completely change that we operate our business? That's something that we think about. And the second thing is supply, right? I think a lot of what we've been seeing in the last few years with just so much construction going on. I mean, we take a very detailed and thorough look at what the supply is. You know, I can say the market, but I'm even talking about like a 5-mile radius, right? To whatever asset is, you know, it is that we're thinking about acquiring, and how that trickles down and what the second order effects are of the asset that we're looking to target in terms of our units, the demographic that's that's looking to live in what we want to, you know, acquire, what that does to rents, what that does to the median income, right? Like all these things are front of mind.
Okay. So 2023, there was a light of that number of transactions, very few. What's your outlook for '24 and why?
No, I think 24 is going to be better, right? I think we're all anticipating interest rates coming down. I think we're anticipating, you know, some shakeup in the elections. You know, I think also, you know, we kind of know where things are. A year ago, there's a lot more uncertainty than there is now. So I think the bid-ask spread is probably going to narrow between sellers and buyers towards the end of 2024. I think also lending is going to loosen up a bit in the third and fourth quarter. So we're optimistic, but we're developers, so we have to be.
I agree. I think the second half of 2024 is going to put more pressure as a lot of this debt comes due. There's like 3 big waves for the next 3 years of debt that's coming due. I think I was chatting with someone, there's like $250 billion coming due this year that's at a 1 debt coverage ratio or lower that needs to be worked out. I think people are trying to feel out. I'm seeing more deals come live now. I think the second half of the year is where deals have to be made.
Yeah. No, I agree. I think it's still premature. Right now, we're definitely seeing a little bit more of an uptick, having a lot more conversations, for sure, with our institutional folks, getting in front of them just to kind of see what their appetite is, what they're seeing in the market. And so they're starting to deploy. I think it wasn't that there wasn't capital. I just think that there was just too much volatility in 2023, uncertainty. And so I think the fog will start to kind of recede the latter half of this year. We'll start to see that. I still think interest rates we probably won't see them kind of trickle down just yet. I mean, inflation, the report just came out a couple of days ago, and it's still looking flat. So it's not going to really move the needle on the Fed. So I still think that we'll still start to kind of see more opportunities in the latter half as some of those maturities kind of come up, and we'll see the kind of opportunities that we can capitalize on.
I think it's going to be slightly better, but not much. Have a sense that there was a lot of hype after NMHC, but now it's died down again. So we're not that optimistic that it's going to change. But on the other hand, if there is distress, it's going to be attractive to us.
I have absolutely no confidence in sitting here and, you know, telling you what I may or may not think the market is heading in the next 6 months or even 12 months. I wouldn't be able to do that wholeheartedly. I do have the confidence to say that if you mitigate interest rate risk and you buy correctly, that over the next 5 or 10 years, you'll probably do pretty well.
Okay. So it seems that some people feel that interest rates will be coming down. For those that do, you know, how big of drop do you think we'll see over the next 12 months?
Well, I mean, I think you just got to listen to the Fed, right? I mean, you know, the Fed states plainly what it's going to do, unless there's some kind of shock to the system. And they've done exactly that, right? So they said 3 rate cuts this year. So that translates into 75 basis points.
I can't predict what the Fed's going to do.
I mean,
My
if
crystal
I
ball
knew
is
where,
foggy.
you know, if I knew where interest rates were going, I'd be doing something else on this fine day today. You know.
Yeah.
Yeah. Are any of you waiting on the sidelines or holding off on deals, expecting the rates, waiting for the rates to drop? or that's not stopping, you know?
I mean, I could quickly take this one. I think, you know, playing, you know, I like to use metaphors, so pardon, but, you know, playing baseball, you can just keep looking at the pitches as they come in, and I have zero incentive to swing if I don't think it's the right pitch, right? So as long as you're patient and your incentives are aligned, then I think that's fine. I think you get into trouble when you try, you know, to swing at every ball that comes your way.
Yeah.
Yeah, we slowed down a little bit. So, you know, there is logic in waiting for the rates to come down. But I think there's also logic in our business of ground-up construction to start now when almost no one is breaking ground on multifamily in South Florida. So, you know, we weigh both, but I think ultimately being first to market outweighs whether the Fed is cutting, you know, rates.
We keep underwriting, we keep testing the market, we keep engaging and stick to a very disciplined approach.
Yeah.
That's what protects us from making a mistake. I think you should be active at all times, at least knowing what the market is offering.
Okay. I know we had slide up, but does anyone have any questions? Okay. I want to thank the panelists for a great discussion, and I appreciate everyone for coming.
Thank you.